My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. You know what? If you've been around real estate for a while, especially if you've been interested in multifamily real estate investing, you know that these days it's kind of a tough haul for a lot of syndicators. A lot of folks got themselves into trouble in the hey, go times of the last few years, and now they're getting in the crunch. They've got variable rate mortgages coming around. Their expenses have gone up. The value of their properties have gone down, and they're in quite a bit of challenging, troubled waters. Well, today's guest, thank goodness, is not in that situation. So Evan Curtis is part of a company called Vanemore. They're based out of Los Angeles, California. They do multifamily investing, and they kind of saw the writing on the wall in 21 and 22 and positioned themselves properly. So now they're getting set to kind of go all in and be more aggressive with their acquisition. So Evan, welcome to the show. Great to have you.
Thanks, Dave. Appreciate you having me on.
Yeah, man. So give us a little snapshot of what you guys currently have in your portfolio as of mid-year 2025.
Yeah, so we're a multifamily value add owner operator. Currently have a little under 150 million of properties in our portfolio, spread out geographically. We've got assets in Oregon. We've got assets in Southern California. We've got a couple assets in Tampa, Florida as well. So we do a pretty broad coverage from a geographic perspective, which I think is interesting right now, given the shift and the transitioning period that we're in.
Most definitely. So how many different communities do you have that make up the portfolio? How many different projects or properties do you guys have right now?
We've got eight properties currently.
Mm-hmm. Across those different markets. Okay, very cool. And what does your buy box look like? What kind of property are you looking for? What kind of size? What kind of price point? And it sounds like you're focusing on value add. Is that continuing to be the focus these days?
We are strictly in the middle market value add space. So we define middle market as assets between 10 million and 50 million in acquisition purchase price. And within the value add space, I like to describe it as light value add. So we're buying properties that are operationally stable. So 93 to 95% occupied, not a ton of bad debt. They are cash flowing day one. We're looking for positive financial leverage, and we're looking for ability to increase revenue on the margin through interior and exterior capital expenditures. And then I think importantly, we focus on the expense side of the equation just as much as revenue. So you're trying to drive NOI, and you can do that via increasing top line revenue, but you can also do it on the expense side as well.
Well, that's what I'm kind of wondering, Evan, because if you're buying them already fairly optimized, I mean, you're looking for cash flow day one, you're looking for very high occupancy, you're looking for very light cosmetic type renovations if anything's necessary. So what is it that you do to increase that bottom line, to increase the profitability, the NOI, by reducing expenses? What have you found that works best for you guys?
Yeah, from an expense perspective, I think it's particularly important because we're operating in the middle market space. So one of the pushbacks and the challenges that you get is that you can't get the same economies of scale in the middle market. And one of the ways that we look to overcome that is we utilize some technology to help us be a little bit more efficient. So for example, on the leasing side, we utilize a AI software that helps us field pretty basic questions more efficiently and ultimately helps us reduce our payroll costs. And it's also a added benefit to potential renters in that they get an instant response to a basic question like, what's your availability? What's the size of the property? How many bedrooms? How many bathrooms? So pretty simple questions you can field. First line of defense can be an automated response, which is beneficial from both sides, from us, from a payroll expense reduction, and from them, it can get immediate answers at any time of the day.
Okay, I got two questions. First of all, forgive my ignorance here, but what's your definition of like mid market? You talked about a price range, but paint a picture for me. Like, typically, how many units in one of these kind of properties
Yeah, it depends a little bit. That one's
on the market?
we define it because we define it based on price because we look at various geographies where the unit price is significantly different. So
Okay,
we're
well,
updating,
let's look at your current portfolio. Like, what size to what size do you have in the eight properties in total?
call it 50 to 100 units.
50 to
The-
100 units.
Yeah,
Okay.
yeah,
Big broad strokes. That's what I'm kind of looking for. Get my head around. Okay. So there's an advantage there because it's kind of like under the threshold that the really big guys are looking for, but they're too big for the little guys. So it's kind of like that Goldilocks formula for you guys. Okay, that makes sense. Now, you were talking to me, telling me a little bit about efficiencies through software and AI. So I'm an old dude, so you have to kind of explain this to me. What does that actually look like? Is that like a bot on a website? Is that how are people using this? How are these renters or potential
sure.
renters taking advantage of this?
Yeah. It's a few things on a chat bot when you're initially having interest. It can answer questions on do you have vacancy? What's the
Like on your website,
policy on the
basically.
website? And
Okay, got
then
it.
from a phone call perspective, the first questions are answered by an
AI.
automated line that can bot that can answer those types of questions as well.
Okay,
And
got it.
some of the other another example of technology that is it's fairly widely used at this point, but is virtual staging,
Hmm.
self-directed walkthrough stuff like that that's very commonly used at the larger properties is not always commonly used at the smaller properties. We're a lot of times looking to buy from mom and pop owners
Okay.
that you have a really low basis. They've been managing it, efficiently
This,
from a
that's probably their only property.
yeah,
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 that's yeah, I got it. So they're not into all of these efficiencies of scale
right.
because that's it. Okay, very cool. Excellent. Any other things that you guys do a little bit differently for lowering expenses, increasing revenue on these fairly optimized properties already?
Yeah, given that we don't have, given that we're very targeted in the properties that we acquire, and we're not acquiring a large volume.
Yeah.
We try and take a very strategic look for special situations where we can add value. So, for example,
Okay.
we acquired a property in Riverside, California, last year, and it has the benefit of being overparked, which is very uncommon. So, we have actually are in process of adding some ADUs, accelerated dwelling units, so increasing the unit count. And we're also able to, on that particular property, they were built very large square footage units, and we can turn a two bedroom, two bath that was 1,650 square feet into a four bedroom, two bath and rent it for $600 more per month. And things like this. There's unique circumstances. We're also putting solar on that property, so some things that
Okay.
work on that one won't necessarily work on another one, and
Yeah.
vice versa.
Very cool. Because I was kind of wondering about that. Because California, from what I understand, it's challenging to make some deals kind of pencil out and make sense financially. So that's smart. Like if you're able to create more bedrooms or divide up units into more units, increase cash flow that way. Over parked, does that mean there's more parking than is actually necessary for that building? So yeah, and then you're putting ADUs on that, accessory dwelling units. But what do those actually look like? Are you putting a couple of townhouses in there? What, like, you got an apartment
Yeah.
building, then what are you tacking onto this thing?
So it was built with 2.4 parking spaces per unit, which is
Wow.
pretty good ratio.
Yeah.
And it had tuck under garages. So the tuck under garages were actually able to we're going to convert those into a one bedroom. So it's going to be roughly 500 square foot one bedroom, so
Okay.
and you can do that without having a meaningful impact to the parking ratio, and you increase the revenue pretty
Of
significantly.
course. Yeah. So I'm trying to get my head around that one. How many units are in there right now? How many rental units in that particular property?
62 units.
62 units. And how many more one bedroom ADUs do you anticipate being able to add to that property?
We're going to test it out with two. You have the
Two.
ability to add up to eight.
Oh, yeah, smart. So kind of do a trial, do a test with two, see how it works out. You can add on six more if it makes sense. And then, yeah, just adding eight more units to a 62 unit property, that's going to increase the value very significantly, I would imagine.
We think so. We
Yeah.
think so. We're excited about that property.
All right. So you were mentioning in the information you sent ahead of time that you guys kind of saw the writing on the wall in 21 and 22 and position yourselves so that you can take advantage of things. What are you seeing coming down the pipeline that fits your buy box? What kind of opportunities do you see happening these days?
Yeah, it's a very challenging market. Even with values down 20 to 40% from where they were at peak 2022 pricing, it's
Yeah.
still very difficult to make properties pencil. And
Mm.
what we're seeing right now is, I think, a slow bottoming from a valuations perspective. You've seen a ton of new supply that's currently hitting the market and is expected to be delivered, which is causing rent growth to be flat or negative. You've got inflation, which is ultimately driving expenses up still. And then you've got interest rates, which are significantly higher than where they were. So the three of those combined has ultimately created this situation that we're in. And we think that we are slowly bottoming now. We've seen cap rates widen pretty significantly. You think from a long-term perspective, there's a lot of opportunity and demand on the multifamily side, especially when you consider the costs of single-family homes and the affordability factor. So, we think that buying well-located properties and focusing on a little bit newer vintage. So we generally
Mm.
like mid 80s construction or newer, but really it's 90s or even 2000s or newer.
Okay.
So, you can pick up properties at opportunistically at a pretty good basis and find some positive cash flow. And then, looking down the line 5 years from now, when some new supply is expected to be significantly lower because construction starts and permitting is way down,
Yeah.
then you're likely going to put yourself in a much better position.
Oh, very cool. No, that makes sense. So, Evan, you guys have got multiple properties across multiple states. They're kind of smaller or mid-sized type properties, what you call mid-market properties. Management wise, how do you guys juggle that? You're in California, but you got some properties in Florida. There's quite a distance there. Are you using third-party management out there, or how do you guys do it?
We use third-party property management. It makes sense for our model for the reasons you said. We're pretty
Mhm.
geographically diverse. It's also when you own middle market properties, you can't always just go with the largest national property management company.
Yeah.
So you need to really be hands-on involved in the process. A lot of other people speak to being vertically integrated as a big benefit, and for some shops it is, but property management is a difficult business and it's a low margin business. And
Mm.
we think that given our current size and structure, it's actually more beneficial to be using third party property management and really, being on the same side as our investors and trying to, squeeze as much revenue as we can and expenses out of it as we can. And
Mhm.
that's the model that makes sense, certainly for now for us.
So, Evan, you're the chief operating officer for the company. So, I imagine I could be wrong. Are you the guy that's kind of in charge of managing the managers in your properties?
So we have asset management as well.
Okay.
So
Yeah.
that falls a little bit more on that side. I'm handling a little bit more of the operational side from a company perspective, as well as I'm very involved with the capital raising perspective.
Okay. Well, let's talk a little bit about the capital side of things. It's been a rocky road for the last few years. What are you guys seeing when it comes to raising private capital these days?
It's ironic. It's now's the time when people should be interested in thinking about
Yeah.
investing, right? Like I said, we're down 20 to 40% from where we were, but
Yeah.
investor psychology is challenging because people see prices falling and they don't want to invest. And on the other side, there's a lot of people who invested in 2021 and 2022 who are not pleased with how the current performance of their portfolio is going, and they're out of liquidity, their properties aren't cash flowing. So I understand that side as well.
Mhm.
But it's a challenging time to find the capital. But like I mentioned, I think it's also the right time for people to be considering multifamily, especially, and just generally real estate. I think there's been a number of property types that have pulled back.
So, a big part of your approach, if I understand correctly, is educating investors. What do you find that works best for educating folks?
I one I think the most interesting thing is most people aren't aware of the magnitude of the decline that we've seen since peak pricing. So I'm passionate about it. You know, I'm in the weeds every day on real estate and all different things associated with real estate. So just letting people, helping them understand that we've seen a GFC magnitude drawdown. I mean, the peak drawdown from 2008 to 2010 was roughly 36%. So, you know, with multifamily down, and it peaked around 30% down from 2022 levels. You're in the magnitude of the GFC, and most people
Wow.
have no idea because when they think about multifamily, they relate it to single family, and single
Mm,
family homes have seen nothing near. I mean, a lot of
yeah.
markets are up since 2022 or flat. So I think that's a very interesting piece of info. And, you know, just talking about anything else associated with real estate investing and just generally investing is exciting to me. And I think people enjoy it. And, you know, I'll have follow-up conversations with them about real estate and other financial topics.
So, Evan, at this point, because so many quote unquote experienced LPs have been burned with other deals under other syndications, and they're justifiably a little bit gun shy, or they might not be in the financial place to actually invest in other deals. Is it more of a situation of finding new investors and educating them about multifamily, educating them that, hey, stuff's on sale now, kind of that, and creating new investors from scratch versus going after people that have some experience? What are your thoughts around that?
It's a great question, and it's actually a question that we talk about internally. You know,
Yeah.
where should we be targeting investors? And I don't know if it's the answer you want to hear, but I think it's both. You know, you
Yeah.
need to stay in touch with with people who are interested and invested in real estate because we're looking to build long-term relationships. We
Hmm.
intend to have people that will invest over a decade of time, and maybe 1 to 2 years is a tough time from a liquidity perspective. We certainly want to stay in touch with them. We want them to continue to see our deals. We want to update them on what's going on. But at the same time, you know, you need to find people who are interested and able to invest in current deals. So we're constantly trying to prospect with new folks and really just try and get more eyeballs on our deals that when we have them.
Yeah, that makes a lot of sense. Yeah, you can't focus on just one. The advantage of creating new investors is you're the guy, if you grab their attention and you educate them and they learn about real estate through you, then you've got a little bit of a fence around them versus them kind of looking everywhere and anywhere for the best numbers and the best deal, which is not always the best idea. But the challenge is you have to start from scratch and start with the ABCs, and it takes a lot more time versus going after people that have some experience. They already drank the real estate Kool-Aid. Maybe it's tasted bad for them the last few years, but they've had some positive experiences, so they can. It might be a shorter conversation or a more direct conversation to show them your deal. So yeah, I see where you're going with that. Yeah, very cool. What plans, what goals do you guys have for the rest of 2025?
Yeah, we're closing on a deal in Tampa next week.
Congratulations.
So excited to get that one
Yeah,
under our belt. That'll be 2 deals in 2025 so far. So
great.
we're off to what we consider a good start. We'd like to find a couple more if possible
Yeah.
through the rest of the year. But you know, like I said, it's a challenging time. So we will keep our heads down from an underwriting and deal sourcing perspective, and we'll
Mhm.
continue to have conversations with potential investors and you know give them education and updates on the market. And when the time is right, hopefully they'll be interested in hearing about what we have to offer.
Sounds good, Evan. If people want to connect with you and find out more about what you guys are up to at Vanemore, where should they go?
Yeah, you can find me on LinkedIn. You can just search my name, Evan Curtis. I don't think there's too many Evan Curtises on LinkedIn from what I've seen. You can also visit us on the Vanemore website, which is vanamor.com, and my contact information as well as the team's contact information is there. But feel free to reach out to me directly at either of those sources.
Awesome, Evan. Well, hey, thanks very much for being on the show, sharing a little bit of your insights about what's going on in the market, and I like your what you guys are doing. It's kind of a different approach and just very focused on a specific kind of multifamily properties. You got a very clear buy box that you want, and focusing on lowering expenses to increase the NOI. That's a smart way. I think you guys are doing a lot of smart stuff.
Thanks a lot, Dave. Appreciate you having me on.
All right, everybody. Thanks for tuning in, and we'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.